Welcome back. Our next guest is a veteran strategist in the U.S. marketplace. He remains overweight stocks as 2025 begins, but he says he's concerned over divergences between winners and losers within the stock market. For more on his outlook for S&P 500 stocks, we're joined by Ed Clissold. He's chief U.S. strategist at Ned Davis Research. Ed, thanks a lot for joining us. Why are you overweight stocks as the year begins and after 2 years where the S&P 500 delivered 20% plus gains?
Well, the main reason is that the drivers of the bull market are still in place. But we have inflation that's approaching the Fed's target, and there seems to be a path for that to continue to move down for a little while longer. And we still have strong earnings growth. And so if you wanted to pin the last 2 years on two things, those would be it. So as long as those are in place, we're going to remain constructive on the U.S. stock market.
I see in your notes, however, that you think this could change as the year progresses. You say that headline inflation could drift back towards 3%. In other words, rising inflation is a risk. You think earnings growth should be positive, but could be slower in 2024. And I think expectations are set pretty high, are they not, for earnings growth in 2024? And you say an additional wild card are Trump policies like huge tariffs on imported goods and mass deportations of illegal residents.
Yeah, and that's where, of course, it gets tricky. You're always trying to look ahead, and yeah, those are some major concerns. On the inflation front, you can kind of divide into three different components. You have the goods side of things, and that has actually been in mild deflation territory, or prices falling year over year, for most of 2024. But if you throw on some pretty big tariffs, that clearly would go away. And then secondly, you have the housing component of inflation, and that's going to be tough to keep declining because of the apartments complex, we call it multifamily housing. We know the supply of new apartments is going to dwindle in the second half of 2025. So that part of inflation may start to move higher. And so then you have to ask yourself the question, how many more rate cuts are there? It's quite possible the Fed may go a couple times next year and then be done. And the market was pricing a lot of rate cuts. Now it's kind of moved to that two rate cut scenario. On the earnings front, yeah, consensus estimates, depending on the data source, is 15 to 17%. That's pretty high considering the fact that we've already done so much good work over the last couple of years, and especially the biggest stocks, the so-called Mag 7 stocks, have produced such great earnings growth, they're going to fall under the weight of the law of large numbers, and they can still produce good earnings growth, but to think you can duplicate triple-digit earnings growth for a third year, it's just going to be pretty difficult. So some of these things are going to come under a lot of pressure, but the final thing I want to emphasize as I discuss this is that you want to wait for the data to actually give you some confirmations happening. For example, the last couple of years, there's been a lot of concerns about the U.S. economy going into recession. If you act on those fears instead of looking at what was actually happening in the data, you would have missed a great bull market. So we're gonna need to have some more evidence here before we cut bait.
A lot of people who watched the U.S. market closely in 2024 said a rotation away from the mega cap tech stocks into smaller cap stocks was a welcome development and a sign of a healthy stock market. But as 2024 came to an end, we saw one key measure of the small cap market, the Russell 2000, lose a lot of ground. What's your take on that situation? Will we still see a sustainable rally out of the mega caps and into smaller cap stocks?
The way I think about this is it's relative versus absolute. So if on an absolute basis, the smaller stocks are rallying, which is pretty much what happened for most of 2024, when the Russell 2000 is up around 10%. It's not a bad year at all. And so that's fine. So if the infantry are leading or following the generals, we're okay. If it's when the infantry starts to desert the generals that we run into trouble, and that's what happened the last few weeks of the year. So if you see things like percentage of stocks above their 200-day moving average, kind of long-term technical trend, that fell from well into the 70s to into the mid-50s. If you look at things like the advanced decline line, it's running total of stocks that go up in a day versus stocks go down in a day. That peaked in November. So these kinds of things, which is what technical analysts call divergences, they develop from time to time. Most of the time, they resolve themselves to the upside, and the bull market continues. But almost every bear market starts with these divergences creeping up. So we got to keep an eye on this. And to bring it into the macro discussion from earlier, the stocks themselves are going to tell you before the economic data. So if these divergences continue, we'll probably reduce our equity exposure a little bit. And then as we get more macro confirmation, then we'll get out more fully into the stock market. Now, those are ifs. Again, we're still overweight stocks. But as these things develop, if that's how it plays out, it's going to make a lot of sense to take some risk off the table.
Okay, why don't we finish with investor sentiment? Are retail investors too euphoric right now?
There's lots of data to suggest that people are pretty fully invested. The inflows into ETFs right after the election were basically at a record high. Look at percentage of financial assets in stocks for U.S. households, that's at a record high. And so it's really a sign that after a couple of years, those doubters have largely come off the sidelines. That doesn't mean the market has to go down right away, but if there's a problem, you don't have those shock absorbers of extra money on the sidelines to come in and buy the dips like maybe you had before.
Ed, thank you a great deal. Ed Clissold is Chief U.S. Strategist at Ned Davis Research.